If you're an Australian property investor looking at your domestic portfolio right now, you absolutely know the grind. I mean, it's tough out there.
Oh, it really is. It's punishingly tight right now.
Yeah, exactly. You're looking at capital city gross yield sitting somewhere around like 3.5%, maybe pushing 4.5 if you're really lucky.
If you're very lucky, yeah. And the margin for error on that is basically zero.
Right. You're parking massive amounts of capital, taking on all this significant debt just to watch the actual cash flow get eaten alive by domestic taxes, rising holding costs, just incredibly tight margins.
When you run a standard cash flow analysis on a domestic investment today, the yield just isn't there to buffer against, sudden financial shocks or these sustained high interest rates we're seeing.
It feels like you're hunting for scraps in a market that just doesn't offer the cash flow it used to,
Well,
which is why today's deep dive is tailored specifically for you.
Hmm.
We're looking 11,000 kilometers away.
to the Middle East.
Yep, to Dubai. We have a stack of sources today, mostly anchored by this really comprehensive guide from Dubai Property for Aussies. It's titled, Should Australians Buy Dubai Property During the 2026 Market Correction?
And it's a fantastic guide. Highly detailed.
It really is. So our mission today is to just give you a shortcut through all the noise. We want to understand this specific 2026 market shift and figure out if buying an apartment on the other side of the world right now is a stroke of absolute genius or, just a really risky gamble.
And we have substantial data to ground this, too. We're not just guessing. The source material pulls hard transaction data from the Dubai Land Department, plus market analysis from Knight Frank and Engel and Volkers, and institutional tracking from Bloomberg.
So we're looking at where the capital is actually flowing, not just opinions.
Exactly. The real money.
Right. So we're going to cover the reality of this 2026 correction, the massive institutional buying signals flashing right now, the exact logistics of remote management, the Australian tax implications, and some specific negotiation tactics you could use. Okay, let's unpack this.
Let's do it.
Because before we can talk about hunting for high yields overseas, we really have to understand the drop itself. I mean, you can't capitalize on a market shift if you don't actually understand why the prices fell in the first place.
Right. You have to map out the current reality first. So Dubai property prices have fallen overall by about 10 to 15%.
Wow, okay. That's significant.
It is, but the decline is uneven. The apartment sector, specifically in those mid-market areas, has taken the heavier hit down up to 15%.
And what about houses?
Well, villas and townhouses are slightly more insulated. They're dropping by about 10%.
Okay, but the guide emphasizes that this is what do they call it, a sentiment-driven correction, right? Triggered by geopolitical tensions rather than an actual structural failure of the Dubai market itself.
Exactly. That distinction is everything.
Because, for those who haven't followed the news closely, we're talking about the regional tensions around the Strait of Hormuz. It's this crucial global shipping lane. And even though Dubai itself is isolated from the direct conflict, foreign investors see Middle East tension on the news and they just freeze.
Yeah, and that's the crucial distinction. Like I said, a structural failure involves, people actually leaving the city, businesses shutting down, or a sudden drastic change in the tax code.
Right, the fundamentals breaking.
Exactly, and we're seeing absolutely none of that. The underlying demand drivers are completely intact. The population just pushed past 4 million, the expat workforce continues to grow, and that globally competitive zero-tax environment is untouched.
The foundation hasn't cracked.
The foundation hasn't cracked at all.
Okay, I have to push back here, though.
Sure.
If the foundation hasn't cracked and things are so fundamentally strong, why did viewing volumes and offers drop so sharply? I mean, it's like a flash sale at a luxury department store caused by a rumor rather than the store actually going out of business. But if the stores isn't closing, why did everyone stop shopping?
Well, what's fascinating here is the behavioral economics of international buyers. You have to remember, property requires hundreds of thousands of dollars of capital commitment.
Right, it's not a small purchase.
Exactly. So when a geopolitical headline like the Hormuz crisis hits, foreign retail investors experience this immediate psychological freeze. It's just a natural human reaction to macro uncertainty.
They just get spooked.
Totally. They cancel their viewing trips, they pause their offers, and they just sit on their hands. And that temporary pause in demand creates a vacuum. It shifts the power dynamically from sellers to buyers, establishing a classic buyer's market literally overnight.
And this is what's crazy. the actual transaction data from the first quarter of 2026 tells a completely conflicting story.
It really does.
Because the headlines were broadcasting this massive price drop, yet Q1 2026 saw 252 billion dirhams in real estate transactions. That is a 31% increase year on year.
Staggering numbers.
Right. So retail buyers might have been frozen by the news, but someone was still spending a massive amount of money.
Yeah, and it wasn't just domestic capital keeping the lights on either. Foreign investment actually rose 26% in that same quarter.
Wait, really? Foreign investment went up?
Up 26%, hitting over 148 billion dirhams. Over 48,000 foreign investors were active in Q1 alone.
Wow.
Because experienced overseas buyers recognized the temporary nature of a sentiment-driven correction. They saw a 10 to 15% discount on an asset class that still has its structural floor intact, and they just moved in.
Here's where it gets really interesting. Because we're not just talking about everyday foreign retail investors spotting a deal.
Yeah.
To understand if this is a safe long-term play, we have to look at what the whales are doing.
The institutional money.
Exactly. The massive institutional investors. And the biggest signal in the market right now is Brookfield Asset Management. I mean, they are one of the world's largest alternative asset managers. They hold, what, $16 billion in regional assets?
Yeah, roughly 16 billion. And right in the middle of this geopolitical tension, Brookfield announced a joint venture with Kuwait's Al Shaya Group to develop a 480,000 square foot mixed-use project in Dubai Hills. Offices, residential rentals, retail, the works.
That is massive.
It's huge. And sophisticated investors of Brookfield's caliber do not allocate capital based on retail sentiment or, evening news headlines. Their moves are predicated on long-term cash flow analysis, replacement cost valuations, and highly detailed supply-demand modeling.
So they intentionally use market corrections for long-term growth positioning.
Precisely.
And the source material draws some heavy historical parallels here. It points to Blackstone aggressively buying up single-family U.S. housing back in 2011, 2012, when the broader market was just terrified.
Yep, textbook institutional play.
Or institutional buyers stepping into the London market at 18-month lows right after the Brexit vote, entirely ignoring the retail hesitation.
We even saw it in Dubai itself back in 2020 during the COVID-driven falls. The investors who bought during that specific window of fear saw the absolute strongest returns of the decade. Institutional capital recognizes when an asset is mispriced due to panic rather than a fundamental flaw.
Okay, I understand the theory, but Brookfield can afford to wait a decade for their mega project to pay off. I mean, they have a $16 billion safety net. Does an everyday Aussie investor looking at a spreadsheet in Melbourne or Sydney really have the ability to play this institutional signal game? I'm not Brookfield. I need to see rental returns this financial year.
That's a fair point, but you don't need Brookfield's balance sheet. You can draft off their strategic positioning.
What do you mean by draft off it?
Brookfield isn't just buying a single property. They are dropping a massive economic anchor into Dubai Hills. That kind of institutional capital acts like a gravitational pull, dragging secondary businesses, retail, and infrastructure right into its orbit.
Oh, so it boosts the whole area.
Exactly. In fact, the data shows that surrounding commercial plots in Dubai Hills saw a 5% valuation bump just 7 days after the Brookfield announcement.
Just 7 days.
Yep. Retail buyers use these institutional moves to locate where long-term stability and tenant demand are actively being manufactured.
Okay, so let's bring this down to the mechanics of the listener's wallet. How does this institutional theory actually translate into cash in an Australian bank account? We established that Australian gross yields are hovering around like 3.5 to 4.5%. How does the Dubai apartment market compare in this specific correction?
Well, the average apartment gross yields in Dubai are holding incredibly steady at 7.07%, according to the Engel and Volker's data.
That's a big jump from Australia.
It is, but that 7.07% is merely the market average. To grasp the actual financial opportunity of the 2026 correction, you have to understand the mechanics of yield on cost.
All right, this is a crucial concept because the purchase prices have fallen by 10 to 15%, but the rental rates haven't dropped at all, so the yield on a new purchase is effectively higher.
Exactly. Let's look at the concrete example detailed in the guide. Take an apartment in a mid-market community like Jumeirah Village Circle, or JVC.
Okay, JVC.
Before the correction, at peak pricing, it cost 800,000 dirhams. And it was generating 56,000 dirhams a year in rent. That calculates exactly to a 7% gross yield.
And today, because of the geopolitical sentiment shift, that exact same apartment is priced between 680,000 and 720,000 dirhams.
Right. The purchase price dropped, but the tenant is still paying 56,000 dirhams in rent.
Oh, wow.
The rental income stream is totally untouched. So if you purchase that asset today for 700,000 dirhams, your gross yield on your actual cost jumps between 7.8 and 8.2%. You're buying the exact same income stream for up to 15% less capital upfront.
I gotta say, I struggle to see how that holds up in reality. Like, if the value of the asset drops 15%, isn't a higher yield just kind of a consolation prize for losing capital value? Why haven't the rents dropped alongside the property values?
It's a great question, and it highlights the fundamental difference between asset liquidity and rental demand. Buying or selling a property is a highly illiquid, capital-intensive decision, right? And it's incredibly sensitive to geopolitical news. When investors get nervous, they pause big capital decisions. Renting, however, is a basic living expense.
I mean, the population hasn't changed.
Exactly. The population is still over 4 million, the expat workforce is still employed, and those people still need a place to sleep. They do not cancel their annual leases because of a news headline about a shipping lane.
Yeah, makes sense.
Rental demand remains fundamentally sticky because it's tied to employment and population growth, while asset prices fluctuate wildly with investor sentiment. And the specific divergence makes mid-market communities like JVC and Dubai South the absolute sweet spot for yield-chasing buyers right now.
Okay, high yields are fantastic, but if we are asking a listener to consider wiring hundreds of thousands of dollars overseas, we have to rigorously examine the pitfalls. And the biggest red flag glaring out from the source material is the looming supply dynamic. I mean, we are looking at 120,000 new units expected to be delivered in Dubai in 2026.
Yeah, that's a massive number. And that volume of supply introduces three very distinct risks for an overseas buyer. First, buying in an oversupplied submarket leads directly to elevated rental vacancies.
Right. And if your property is empty, your 8% yield is literally zero.
Exactly. Second, buying off-plan from developers with weak balance sheets. In a high-supply environment, REITer developers often delay construction handovers to manage their own dwindling cash flow.
And third is the currency risk, right?
Yeah.
Because the UAE dirham is pegged to the US dollar. So if the Australian dollar strengthens significantly against the US dollar, the relative returns you bring back home could be heavily diluted.
Yep. All three require careful mitigation.
So if I'm an investor evaluating deals from a laptop in Sydney, how do I actually mitigate that first risk? How do I know if a specific Dubai suburb is about to be swamped by those 120,000 new units? Because I can't exactly just drive through the neighborhood to check out the construction site.
No, you can't. But if we connect this to the bigger picture, that 120,000 unit figure forces discipline. You can no longer just, throw a dart at a map of Dubai and expect it to perform.
They have to be targeted.
You must pivot strategically towards structural catalysts, and the guide specifically highlights the new Etihad rail station precincts coming online in 2026.
Why does a train line matter so much in this specific market?
Well, Dubai has historically been a highly car-dependent city. When you introduce a major functioning rail network that connects the entire UAE, it fundamentally changes human movement.
Oh, I see.
Suburbs like JVC and Dubai South are confirmed Etihad rail station precincts. If there is an oversupply of 120,000 units, the apartments sitting in massive traffic bottlenecks will stay empty, while the ones within walking distance of the rail will stay full.
Because expat tenants will happily pay a premium to avoid the daily commute.
Exactly. You mitigate supply risk by buying near structural growth catalysts that alter tenant behavior.
So we've mapped the opportunity, the discount, the institutional signals, the yield on cost math, and we've mapped the risks, the oversupply, and the necessity of rail infrastructure. How does an Australian investor actually execute this? Let's walk through the exact step-by-step actionable playbook for evaluating deals and managing them remotely.
Sure. We start with evaluation and negotiation. The market dynamic has shifted toward the buyer for the first time since 2022. You want to target properties that have been sitting on the market for 60 days or more.
So look for the stale listings.
Yeah, those sellers are highly motivated, often feeling the pressure of the negative market sentiment.
And the guide points out that your biggest weapon in a buyer's market isn't just offering less money, it's speed. Offering a 30-day settlement is currently worth a 2 to 5% discount from a motivated seller. So if you have your finance sorted or you're paying cash, leading with a tight timeline really forces the seller's hand.
It absolutely does. And for off-plan properties, the negotiation tactics shift. Developers are facing that incoming supply of 120,000 units, and they are desperate to maintain their sales velocity.
So what are they doing?
To keep sales moving, they are extending their post-handover payment plans. What used to be a strict 12-month payment term is now being stretched out to 24 or even 36 months after you take the keys.
Oh, wow, that's huge.
It is a massive advantage for Australian buyers because it reduces your upfront capital requirement and allows you to manage the currency conversion over a much longer period, smoothing out the exchange rate volatility.
Okay, let's assume you close the deal, you own the apartment.
Yeah.
Now you have to manage a tenant from 11,000 kilometers away. What does a local property manager actually do to earn their fee in Dubai?
Quite a lot, actually. Immediately post-settlement, your local property manager handles the EJRI.
EJRE, what's that?
It's the mandatory government tenancy registration system in Dubai. It officially registers the lease, which legally protects both the landlord and the tenant and mitigates potential disputes down the line.
Okay, good to know.
Plus, they handle all the day-to-day maintenance, and crucially, they route your rental income in dirhams directly to your Australian bank account every quarter using an international transfer service. Honestly, most Australian investors manage their entire Dubai portfolio without ever stepping foot on a plane.
We also need to factor in the upfront purchasing costs, though.
Yeah.
There is no annual stamp duty or land tax in the UAE, which is, that's a huge relief compared to the Australian system.
Definitely.
But there is a one-time Dubai Land Department, or DLD, registration fee of 4%. So on a 1 million dirham property, which is roughly 420,000 Aussie dollars, that DLD fee is 40,000 dirhams, or about 16,800 AUD, and that has to be factored into your upfront cash modeling.
It does. Which leads directly into the most complex part of this entire strategy for Australians, the tax implications.
Right, so what does this all mean? Because from the outside, it sounds like the UAE is throwing an incredible tax-free party, right? There is no income tax, there is zero capital gains tax. But the Australian tax office is still waiting at the door when you bring the leftovers home.
That is a perfect way to put it. The UAE tax framework hasn't changed. It remains entirely tax-free for the asset itself. However, if you are an Australian tax resident, you must declare that Dubai rental income to the ATO. It is assessed as foreign income and taxed at your standard marginal tax rate.
You can still claim standard deductions, though, right? Like management fees, interest on the mortgage, depreciation, maybe reasonable travel expenses if you fly over to inspect it.
You can, but you have to remember that because the UAE doesn't levy any tax on that income, there is no foreign tax credit available to offset your Australian tax liability. You bear the full weight of your marginal rate on the net profit.
Ouch. And make the listener feel the weight of this. What happens when it's time to actually sell?
This is where investors get into serious trouble if they aren't careful. Full capital gains are assessed in Australia. Imagine you hold the property for 10 years, it appreciates significantly as Dubai matures, and you decide to sell.
Oh.
If you bought that property in your personal name, that massive capital gain hits your personal tax return in a single financial year. You do get the standard 50% CGT discount if you've held it for over 12 months. But the remaining gain could still push you into the highest possible tax bracket, literally wiping out a huge portion of your profit.
So the consequence of getting the structure wrong from day one is just a massive, unexpected tax bill from the ATO.
Exactly. That is why the ownership structure, whether you buy in your individual name through a self-managed super fund or a family trust, is absolutely critical before you sign a single contract. You have to use an Australian tax advisor with specific international property experience to model out the end game before you buy.
But the guide makes a very compelling final point. Even with the ATO taking their full slice of the pie, when you model this like for like against domestic options, starting with that 7.8% base yield that you secured at a 15% discount, it historically outperforms what you can achieve in the highly taxed, low-yield Australian capital city markets right now.
Yeah, the mathematics of the investment simply scale better when your entry price is significantly corrected and your base rental yield is nearly double what you would receive domestically.
Let's bring this all together. The core thesis of the sources we unpack today is super clear. The 2026 Dubai property correction is offering frustrated Australian investors a highly unique window.
A very unique window, yeah.
We're seeing 10 to 15% discounts driven by sentiment, not structural failure. We are seeing 7% plus holding yields, and we are seeing massive institutional validation from players like Brookfield dropping economic anchors in the city. But It is only a viable opportunity if you rigorously mitigate the incoming 120,000 unit supply risk by targeting infrastructure hubs like the Etihad Rail, and this is big, if you structure your taxes meticulously back home.
Right, it requires disciplined execution, not just chasing a headline discount.
Exactly. Now, I want to leave you with a final lingering thought based on everything we've explored today. We saw international investors actively increase their spending in Dubai by 26%, right in the middle of severe geopolitical fear.
Right.
So what happens to the prices when those 120,000 new units are finally absorbed by the growing population? What happens when the Etihad Rail is actually running, shifting how the entire city commutes?
It's going to change everything.
And what happens when global sentiment inevitably normalizes and the fear just dissipates? Is it possible that this temporary Hormuz shock isn't just a brief window for a flash sale discount?
Hmm.
Could this actually be the exact moment that Dubai permanently transitions from being a speculative boomtown into a mature, institutionally anchored safe haven?
I mean, that is the defining question for anyone looking at the market today.
Truly. Well, thank you for joining us on this deep dive. Remember, when you're hunting for yields in a tough market, always keep questioning the consensus. See you next time.